Works. Lens cover. Working now. Good. We can see you. Okay, do you want me to turn you want to put the lens cover back on? I get it. All right, so I got a lot of things for you today. Some interesting questions. You guys send in great questions. I'm going to show you behind the scenes on YouTube at some point too, because we get a lot. It has to do with the commenting, and even actually Salty brought this up. I think he thought maybe I was, I forget how he put it, but like either editing or deleting his comments, and I promise you I'm not. But there's some things you need to understand about how comments work in YouTube, particularly as it relates to spam. So I'm going to actually show you what I see, in my account, and it ain't pretty. All right, but we're going to start with a number of emails that you guys sent in to me. And the first one, this is sort of the main topic of the show. It was a great email. It was from a listener named Justin. He says, I know you are not an advocate of timing the market, but is there no price at which you'd refuse to buy the S&P 500? What if it had a PE of 250, 500? Let's assume the S&P reaches a PE of 80, just like Japan did. Would you still advocate dollar cost averaging into index funds? And he says, and another good point, context matters. So let's assume the underlying economy is robust and healthy. No temporary issues have caused earnings to plummet. And there's no reason to expect companies to do better than the 6% growth they've seen this century. Well, that's a great question. And you might say, well, Rob, the title of this has Bitcoin in it. What's that got to do with Bitcoin? Well, I thought, I get his question in some form or another from a lot of people. You see it with sort of dollar cost averaging versus lump sum. What should I do? Stocks are highly valued. We all understand that. And I'm nervous. I'm afraid I'll put a lump sum in and the market crashes. What do I do there? If you're like me and you're near or in retirement, then you've got all those worries about the market, right? So I get it. But the reason I bring Bitcoin into this picture is that I get literally between questions and comments, and I'll show them to you a little bit later in the show, and email. I literally have received thousands of questions from folks from YouTube. Not once has anyone asked me, is Bitcoin overvalued? I'm really nervous. Should I be buying it? It keeps going up, and I'm scared. I'm just wondering. It just seems overvalued. No one ever has said that. And I think it's an interesting contrast between the style of investing between something like an S&P 500 and Bitcoin. And I want to kind of explore that a little bit. As part of all that, let me just first talk about the S&P 500 and the PE ratio. Here's the site I go to the most. It's multiple, mutpl.com. And this has the Case-Shiller PE on it as well, which is based on the last 10 years, adjusted for inflation. So it kind of smooths out earnings over, in theory, an economic cycle, let's say. But this is just the straight up S&P 500. This site has it at 34. One thing to keep in mind, like if we were, let me just show you this. If we were to go to Morningstar, right? And we were to look at an S&P 500 index fund like VU, which is Vanguard's ETF, and I'll show you this here in a second. So here it is, right? So this is effectively, right, the same thing as this. It's the S&P 500. And if you look and you go to, I'm going to just go to portfolio, and we look at the PE, it's going to be very different. Probably around 20, 21. So here it's right here, 2182. And it's like, well, who's right? Well, so Morningstar always uses, I think always, there may be some exceptions, but they use the forward PE. So they take estimates of what the companies, in this case, the S&P 500, will earn over the next 12 months and use that in the PE formula. And this site uses trailing 12 months. Now, still, there are other issues with a PE, because what do you do with companies in the S&P 500 that say have lost money over the last 12 months? How do you factor in a negative number? And different formulas handle that differently. In any event, I think this is as good a measure as we'll find. I generally prefer the trailing 12 month over forward, but I guess they both have their purposes and uses. So as I thought about Justin's question, and I think this is interesting thought experiment. Let's imagine. Let's see what. Let me see what the market's doing right now. I'll pull this up for you. Here it is. Let me get rid of that. Here we go. I always look at the stock app. Can't move it over any further, but let's see. The S&P 500's up 1.5%. So let's imagine this. Let's imagine that starting now, the S&P 500 just goes crazy, and by 2 o'clock this afternoon, it's tripled, right? So it's got a PE of, we'll call it 90. I guess that's a little higher than what he asked in his question. He had 80. What would you guys do? Would you sell? Would you keep dollar cost averaging? As I thought about that question in response to his email, I thought, well, if it literally tripled today, I'd probably sell. I'd probably sell, well, whatever tripled. I mean, if the S&P 500 goes up triples in a day, your total stock market fund is going to do the same thing effectively. And I'm assuming international stocks would be along for the ride, but who knows? But whatever. I probably would sell and take a big tax hit. And the reason for me, though, I don't think would be because I expect it to fall the next day. Although I guess I probably would if I were a gambling man, I probably would bet that it was going to fall, if not the next day, real soon. But because of just valuation, right? It's just, to me, it would be so incredibly overvalued. But that raises a question. It's like, okay, well, Rob, that's fine, but then what's the number? You'd sell at 90, all right? Would you sell it at a PE of 89, 88, 80? And we can just keep counting backwards till we get to the current PE of 34. And that's the real problem. The stock markets don't normally triple in a day, right? That's not how some investments might. I guess Bitcoin can, I don't know. But, the S&P 500 probably not, right? And so it goes up a little bit at a time. It fluctuates, right? So how would we pick a number? And let's just pick one. Let's just say 40. If the PE got to 40, we're out. Well, how would that look? I mean, so let's literally say it goes over 40, so we sell. We set that rule up ahead of time, and we sell. And then the next day it goes down, it's back to 39. Do we buy? Are we all the way back in? And then what if a week later it goes to 40 again? The problem when you set a number like that is that it can cause you, well, there's a couple of problems. One is it can cause you to do what I would think would be some irrational things. In the abstract, it might not seem irrational to sell when something is significantly overvalued, whatever that means to you. But, as long-term investors, you're going to see it move up and then move down. And are you going to keep changing as it sort of hovers over whatever line you've drawn in the sand, right? The second thing is that I think it can be really hard to implement as a practical matter. So, for example, what if you said, okay, well, Rob, we can solve that problem. Here's what we're going to do. If it goes above 40, we'll sell, but we won't buy until it falls back below some lower number. That keeps us from, going back and forth as it just hovers over whatever number we've chosen. So maybe we won't buy back in until it's back to 25, just making up a number. But what happens then if it doesn't go back to 25 for 5 years? Are you just out? And I guess that's what you'd be. You'd be out of the market, right? And I don't know what you'd be in. Cash? I doubt you'd be in bonds today. So there's a real practical problem, right? And so here's where I come out on all of this. I think there are basically, and I'll tie it back into Bitcoin. I think there's two reasonable ways to invest. Just two, really. There could be more, but two of the main ways. One is what I call being a value investor. You're looking to invest in something that you think is a good investment, but also reasonably priced, preferably below what you think its value is, usually determined based on cash flow and what you think the company's or the investment's cash flow will be, which is not always easy to tell. I mean, when I try to value a company, it's never a dollar number. It's always a range. But that would be sort of Warren Buffett, Guy Spear, a lot of Howard Marks. There are a lot of value investors, a lot of ones that I think are worth following, even if you're an index fund investor, because you can learn a lot about the market and the economy and everything. So that's one approach. I'll call it the Warren Buffett approach, right? And I do that with individual stocks. That's 20% of our portfolio. I own 4 companies. We're going to actually look at a portfolio today that someone sent me that's got 110 positions, I think. In any event, I only have 4 stocks. And so that's what I try to do with those investments. That's one way. And the other way is sort of, I'm going to invest in the market, dollar cost average, in the sense that, I mean, you might also have lump sums from time to time, a bonus, an inheritance, whatever. But most of the time for most people, it's investing in a 401k, each paycheck, or whatever. You're dollar cost averaging, and you're putting it into some kind of asset allocation that's low cost. So I think for most people, most of the time, that's index funds. I wouldn't say that you'd never put something in an actively managed fund, because there are some good ones out there, but for me, it's all index funds. And I'm not going to actually consider valuation, which seems kind of wrong in a way. But the idea is, look, yeah, in my lifetime, you're investing from whenever to, when you go to that great big mutual fund in the sky. And there can be times when the market's up. There's going to be times when the market's down, when it's, reasonably priced, whatever. And I think it's very, 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 very difficult, both for technical reasons, for emotional reasons, to try to time that. Whether you're trying to time it in the sense of you have this feeling that the market's going to do something in the next 6 months, or even just based on valuation, because you could end up in a situation when you're out of the market, even though it might continue to grow for quite a long time. I mean, folks could have made sound, logical, reasonable arguments why you shouldn't have been in the market over the last 5 years, or even longer, really. Certainly, if you're going to look, if we go back to, let me pull up. Give me just a second. If we go back to, the Schiller, I mean, the mean is like 16. Yeah, the mean is 16. Well, my goodness, with the exception of, I guess, since 2011, when it dipped below 15, we haven't been below the mean in a decade. You could have easily, like in here, when it's over 20, close to 25, argued, well, it's overvalued. So I do prepare myself mentally. I look at this valuation now and I say, yeah, I'm going to be in for some pain. I don't know when the pain will happen. I don't know what will trigger it, but it's coming. It just will. Yeah. And so that's my approach. And the interesting thing about Bitcoin, this is where it ties back into Bitcoin. And I know some of you invest in crypto. Actually, I'd like to know, say in the chat whether you invest in crypto. I'm not here to criticize folks that invest in crypto. Some people have made a fortune. But it doesn't fit either category, really, right? It's certainly, you can't think of it as a value play, because there's no way to value it, right? I mean, if we look at Bitcoin prices today, it's 54,000. Let me refresh this. Yeah, it's just under 54 grand. Is that overvalued or undervalued? Well, it's neither. There's no way to even speak about it, I don't think, in an intelligent way in that context. It doesn't do anything. It sits there. So it's like gold in a way. I mean, gold has some uses, actually, that Bitcoin does not. I guess in theory, you could say Bitcoin could be used as a currency. But let's be honest, that's not the attraction folks have to Bitcoin. So there's you can't really think about it, well, I'll buy it when it's undervalued. How would you even assess the value? Now, by the way, if you have a way to value Bitcoin, I'd love to hear it. Put it in the chat, but I'm not aware of a way to meaningfully say Bitcoin is worth X, or even a range. And I don't. You can't treat it like you would dollar cost averaging into, say, index funds. It's just totally different. And so it doesn't fit any category. And I owned a little Bitcoin years ago, but it was more of like a gimmick thing. It was literally like $100 worth of Bitcoin. I was writing about it since it was under $1. I mean, I look back and I think, I so wish, like, if I had a time machine, I would have just hooked up my computer and mined Bitcoin, because I knew about it and was writing about it at a time when it was very, very cheap and you could mine it a lot easier than you can today. But the reality is, let's say I had $1,000 worth of Bitcoin at a dime a piece. You think, well, Rob, you're a billionaire. Well, no, I wouldn't have been. I wouldn't have even been a millionaire, because I would have sold at some point, 25 grand, 50 grand. I mean, I don't think I would have held on to it as its price went up. At some point, I just said, well, this is just crazy. I would have sold it. I think those folks that have become insanely wealthy and were into Bitcoin early on, and I'm sure there's exceptions to this. This is just an overgeneralization, and I could be totally wrong. But I suspect it's because they believed in a currency not controlled by governments. And I get the attraction to that. I mean, I think there's some significant disadvantages to that as well. But I certainly get the attraction to that sort of thing. And I'm not always happy with what central banks do. Not that I'm an expert in that sort of thing, but yeah, I think the folks that made insane amounts of money probably were what I would call true believers. It wasn't about making a buck for them. Again, yeah, there's going to be exceptions, but I think for those folks that are interested in Bitcoin just because they want to make some money quickly, how long do you hold on to it? I mean, let's say even now you bought, if we go back to this chart, let's say we bought on September 21st for 41 grand, 40,600. It's now 54 grand. I mean, do you sell? And what's the rationale? If you sell, why? If you don't sell, why? And that's where I have a really hard time with Bitcoin and cryptocurrencies generally. I did own a couple of Ethereum for a little bit. It's more just I was interested in the technology, but I think I literally held it for a few days. So I don't own any crypto now. But going back to Justin's question, if I'm dollar cost averaging, yeah, I'm probably going to always put it in. I think trying to make the decision as to when I would stop that, and if I stop it, when I would start it back up again. When would I turn my 401k investments on again, or move it from cash in the 401k to an index fund? I think I'm probably more likely to mess that question up. So yeah, I wouldn't do it. So that's Justin's question, and that's my reply to it. I think it's a good question. There's no doubt that stocks are richly valued, and that we will be in store for some pain at some point. And the worst part about it, and to make matters worse, it'll likely occur amongst some other really bad things, right? The stock market usually doesn't crash and everything else in the world is just peaches and cream, right? Take the COVID, for example, when it really went down for a short period. But there's usually some other crisis, or our government's going to default on its debt, which they won't, but there's something big going on. And so, yeah, it's coming. I just don't know what it will be. All right. So I'm just going to flip through and see if you guys have comments on that topic before I go to the next one. Yeah, Sam says there's no valuation for crypto except market capitalization. I mean, yeah, what's the value of crypto? Well, its current price, right? I guess that's as good as any, right? That's well, let me do this then. I'm going to show you. I've got more emails I want to cover, but I want to show you the comment and what I'm dealing with. So let me show you the behind the scenes. This is what I see when I log in. I'm in the comments section over here. So I see all of your comments. And I wanted to show you this one. This is from Veronica Gregory. And you might be saying, well, who's Veronica Gregory? Veronica Gregory is nobody. That is a fictitious YouTube account, and I'm sure a fictitious picture. And I see a lot of these. I just came across your channel while researching the stock market. I've read tons of success stories of people that made millions from stocks. I'm quite new, and I've set aside $200,000 to begin. I'd love practical steps on how to 5x my capital in 3 years. Even the question is 5x your capital in 3 years. Anyway, look at this, 78 thumbs up, 6 replies. And you get down here, eventually you see what the game is. These are all fake accounts. You get right here. Evelyn Monping, I guess, is my investment manager. Her website is on the web. I find that most of the better websites are on the web. Okay, so just punch and look up the name. So I get this all the time. Now, I can do a couple things with this. I can report it. If I try to report it, I get, these are the options. And I've reported, I don't know, hundreds, thousands. I don't ever hear from YouTube or Google. I don't know what they do with this. And it doesn't slow down the spam. By the way, we can actually look at this account. If we do that, of course, it's all blank. Nothing's here, right? And if you go to About, you can see they just created the account a few days ago. So what I tend to do, I report some, but it's kind of a waste of time. So I just come in here and I hide the user from the channel. So of course it doesn't stop it because then they've probably got bots or something that create these accounts. I don't know how they do it. But someone else will be back, but I hide the user from the channel. And that gets rid of all the replies as well. Now it gets worse. Those are actually not the worst ones in my view. I'll show you. To fight this, I have certain watchwords that will automatically hold a comment for review. So if you use a certain word in a comment, it automatically gets held for review. So of course, those words include Michigan. Oh, that was just kidding. No, love the Wolverines. But seriously, here's what I do. So here's all the ones held for review. Bitcoin actually, by the way, is one of the words because Bitcoin, that's, I don't know, the scammers love to scam Bitcoin. I'm going to see if I can find one. Here's one this is to me the worst kind. It's this one right here. So this was, I think, this is a legitimate comment, right? 4 days ago. Like your analysis, would you consider just buying the QQQ and forget it? It beats S&P 5, 10, 15 years returns significantly. That's a legitimate comment. And my answer to that question, by the way, would be no, because I'm not confident it will beat the S&P 500 over the long term. That's not to say some allocation to QQQ wouldn't be reasonable, but I wouldn't replace S&P 500. Anyway, then you see this, and they make it look like me, right? They got my picture, my name. It's kind of awkward. It's blue and kind of italics. And I don't know what triggered this to go into review. Oh, blocked words. And I don't know what the blocked word is. In any event, so I can just hide the user from the channel. I don't worry about those so much when they're held for review. The problem is, you guys could have a legitimate comment that a word gets triggered and it gets held in review. I do my best to review these and get rid of them, but it really is a flood. I mean, I could probably literally, I could probably hire a full-time person. And I want to show you, I'll read to you the words that are blocked. Well, there's a lot of symbols that are blocked. Bitcoin, for more information, love to introduce, the word text, because they want you to text them at some WhatsApp number. Thank you, feedback, that came up a lot. Thanks for contribution, a number of symbols. Thanks for watching, which you guys probably wouldn't say that. I might, in theory, I suppose, but that was coming up with a lot of spam. So anyway, when I see patterns, I add them to the watch list. So all of this is to say a couple of things. I really am working hard to keep spam off the channel. I'm probably, it's 2 steps forward, it feels like 3 steps back. I am trying. 2, I don't ever edit or delete someone's legitimate comment, certainly because I disagree with it. I don't ever do that. The only time I would do anything is if I thought people were being mean or maybe overly political in an unhelpful way. I mean, politics are part of money, so that's just the reality. But you could end up with a comment that's held for review because of a word you used, and I might not see it. Because if we go back to this held for review, I mean, it goes on forever. They just reload when I hit the bottom of the page, right? So I do my best, but I literally could spend forever. All right, so that's my life behind the YouTube. That's what I deal with when I'm not on camera. This is much more fun. All right, so that was Justin's question. I've got a few more I want to read to you. I wanted to mention a book. One of the listeners, his name is Scott, wrote a book and published it. And I thought, well, I'm going to give him a shout out. And I had it up on my screen, and now it's gone. So let me pull it up real quick. It's a very specific book. It's going to be relevant to people that live in Pennsylvania. But it's financial literacy for employees of Pennsylvania public schools. So if that's you or you know someone, you might want to check this book out. Let me pull it up for you if I can find it. Why am I having trouble? Huh. Bear with me. I just had it up and I can't find it. Here it is. Here we go. There's the book, just published, just released. And I wanted to share it. If folks listening are authors, particularly if it's about money, I'm happy to. I'm happy to share your book as long as it's. I mean, I'm not going to share one on how to day trade. you know, in any event, Scott, thanks for writing in, and I hope the book does well for you. All right. Here's another one I got, and I am going to turn to the chat with all your questions, but I want to just go through a couple of emails. Thought this one was interesting. It comes from Neil. He says, I'm a new subscriber and absolutely love your videos. I know you're busy. I don't want to take up your time, so I'll be quick. I was curious to get your take on a two-fund portfolio. It's a long-term portfolio consisting of 50% VTI and 50% VGT. So I'll show you this. I'll show you this using Stock Rover, which is a tool that I've been using more than Morningstar lately because there's a lot more to it. But so we know VTI, that's the total stock market, right? This is VGT, which is a Vanguard, you can see right up here, Vanguard Information Technology Index. And there's obviously a lot of data here. It's low cost fund. And we can see what it invests in. Well, so first of all, if we look over in the middle here, let me see if I can make this a little bigger for you. Maybe. It's mainly, I guess, all U.S. companies. Or nearly all. But this is what I found interesting, is when you look at the portfolio and it shows you the percentage, just between Apple and Microsoft alone, it's 37%, right? And if we actually add a ticker, we add VTI, of course, it's not as big, but we'll call it 10% between those two companies. So this portfolio is really heavily weighted to just two companies, right? And then of course it trails off, but if you look at just the top 10, that's going to be pretty large as well. So I'm personally not a fan of this portfolio. I think it's too concentrated. I know that VGT has done extremely well. And actually, I mean, we can look at it. If we look at VGT, we can go to the chart and we'll look at, that's just 1 month. We can go max, what's that give us? Back to 2007. And then we can compare it, and let's see, I was looking at Bank of America. We'll get rid of Bank of America. So we can compare it to the S&P 500, and they were kind of neck and neck for the most part, but obviously over the last number of years, technology has far outpaced the S&P 500. They've kind of outpaced everything. And so you can look at it and say it's done really, really well. I actually see this as a warning sign, not a positive. It concerns me that we're going to get to a point where we're going to rotate out of growth stocks, which is, VGT is heavily growth, and back into value. I don't know when that's going to happen, but for me, this would be way too concentrated. We can actually click on the S&P 500. It makes it a baseline and gives you an idea. I mean, really, VGT has crushed it. So this portfolio, if you invested in it over the last 10 years, or even going all the way back here to 2007, you'd have done great. But if I'm thinking about the next 10 or 20 or 30 years, I would personally be very concerned with that portfolio. If I believed in technology, and I don't say that as if I don't, but in other words, if I wanted to tilt my portfolio to technology, I might do that. And I think VGT is a perfectly fine way to do it. But I wouldn't do it 50%. And that's even assuming I had a 100% stock portfolio. Obviously, for me, I shouldn't say obviously, but I don't have a 100% stock portfolio. So that's my take on it. And want to answer a couple more questions, and I'll turn to the chat. This one came from John, and he kind of had two questions, totally unrelated to one another. One was, I'm kind of losing money on my flexible spending account because I'm not using it all. Remember, with a flexible spending account, say for medical, they have them for childcare as well. You have to use the money, and I think I haven't had an FSA in forever, but I think you now get into the next year, like maybe to March. I'm not sure. Don't quote me on that, but basically you have to use the money or you lose it. On the other hand, if you have a high deductible health plan and with that a health savings account, you don't have to use it. In fact, you can keep that account, forever, really. So, and the question is, is that a good approach? And so I love high deductible health plans, and I have one now. I have an HSA, and I've had one for years. I think the first key thing, though, has nothing to do with the HSA. In my opinion, and maybe there's some health insurance experts listening, you can weigh in. The question is, can you afford the out-of-pockets and the deductibles with a high deductible health plan? And you can look at them, and I'll show you this. This is from some website that I don't know, but I'm going to assume that the data is correct. I don't know why I'm going to assume that, but I think it is. So there's two things to look at. The first is what qualifies as a high deductible health plan. Now, if you're like through your employer or whatever, they're going to tell you. Like when you look at it, it'll say it's HSA qualified or it's a high deductible plan. But you can see for 2021, to qualify as a high deductible health plan, HDHP, for a single, it's got to have a deductible of at least $1,400, and for and an out-of-pocket max of at least $7,000, and for family, $2,800 to $14,000. The first question is, can you afford that? I mean, yes, you might have an HSA, which from a tax perspective is a wonderful account. You also may have an employer that puts some money into your HSA for you. So you absolutely want to factor that in. In my view, if you can afford the deductible, even without the HSA, I would pick this. My view of insurance is that you want as much as you need, but no more. And so if I can self-insure with, for example, high deductibles, I will. So we have the highest deductible that Nationwide allows, which is where we have a lot of our insurance, for cars, for our home. And I'll do the same thing with insurance to keep prices down. I think that's just a smart way to go if you can afford to handle the deductibles when something comes up. If you can, I think a high deductible health plan is great. I love the HSA. Our plan with the HSA is we're not using it right now. And I don't plan to until we're much older. Of course, circumstances could change. We all know that. But my thinking is, as you go through retirement, generally costs go down. You don't spend as much when you're 90, typically, as you do when you're 65. And that makes sense to me. That's certainly consistent with my experience with family and friends. But one thing that does go up are health costs, right? So I'm kind of viewing the HSA as covering health costs when my wife and I, are in our 70s, 80s, obviously if we live that long, in our 90s. And that's my plan. And of course, if you don't, let's say you get lucky and you just don't have big health costs, you can use it in retirement to avoid the 10% penalty. You have to wait till you're 65, I believe. That's the one curveball, right? It's not 59.5. And of course, you get taxed on the money. It kind of turns it into sort of a traditional, if you will. You still keep the tax benefits you got when you made the when you made the contributions years earlier, and you didn't have to pay taxes on it. So that doesn't go away, but you would have to pay taxes on it when you take money out for reasons other than qualified health expenses. So I love HDHPs and HSAs if you can afford a deductible. The second question he had was, and I may do longer videos on some of these, but I just wanted to answer this. What are the arguments for having a financial advisor? And he had a bunch of issues and sort of mistakes that he made with his own investments. So here's my deal on that. I think if you're not comfortable managing your own investments, that'd be, I guess, the main reason, or you just, you don't want to. You just would rather do something else with your time. Although it's not that time consuming, but it's not time consuming in the sense of how much time you have to spend doing things. I think it is kind of time consuming, though, if you think about it from the time you have to think about it and maybe worry about it. That can be time consuming. Of course, just because you have an advisor doesn't mean you're not going to worry about it as well. The real key is, how much do you pay for an advisor? And I would go with a flat fee. That's what I would do, or a very, very low fee. I'm working on a list of those folks. One thing I wanted to mention and to show you. So this slide, I don't know anyone. I'm not familiar with Asset Builder. I mean, I'm familiar with the company. I don't know anyone behind it. But they're basically, as I understand it, they're a big believer in low-cost index funds. I think they're out of Texas. I don't know why I think that. Yeah, Plano, Texas. I don't know why I would remember that. In any event, their average fee is 35 basis points. It can be as high as 45, but their average fee, I guess it's depending on how much you give them to manage. So this is not a recommendation. I don't know the folks behind Asset Builder, but this would be the kind of thing that I might consider. I might consider Vanguard Advisory Services. They're 30 basis points. Um, or you could consider a flat fee, to help you. So I think getting help can be a great idea. And even if you're a do-it-yourself investor like I am, it may be great just to run your portfolio by someone and ask them questions like Roth conversions and best way to claim Social Security. And I use Mark Zorel for that, Plan Vision. But there are others out there. I am working on a list. One thing, though, that I want to zero in on John's email. Here's what he said. As another example, my advisor has advised me that the market should be good for approximately 1 more year and to stay aggressive, and more than that, they were aware of the effect on market because of COVID 6 months ahead. That comment really, and maybe it's just an offhanded comment, that comment would actually concern me about an advisor. At least it almost sounds like market timing. I would drill down on that question. Well, why do you think it's going to be good for a year? Do you plan to make a change at a year? What will trigger that change in my portfolio? Is it just time? A year from now, there's going to be a change to my portfolio that you want to make? Or is it something else that you're seeing? That actually concerns me. If an advisor said that to me, I think it would be a short conversation. All right, I've got more, but I think we'll stop there in terms of the email so I can get to your questions in the chat. Thank you for your listening to me. Let's see what we got. One person mentioned, by the way, that some YouTube comments can disappear. I suppose that's true. I don't think I've ever deleted like a legitimate comment, or if I have, it was really nasty. Foul language, I don't like that. And by the way, it's not a, look, I've said a few things in my day, but it's YouTube, it's public. Who knows? Kids read this. I don't know. We can express ourselves in ways that are, I don't know, appropriate. I don't know. Anyway, let's see. Oh, yes, I wanted to show you this portfolio real quick. This was sent in to me. Here it is. This is the portfolio. I don't know how well you can see that. Let me see if I can make it bigger. Maybe bring the columns in. So someone wanted my comment on this portfolio. And if we just scroll to the bottom, you can see there's 112 companies. This person doesn't own any funds. Berkshire's 25%, Apple's 7%. Actually, Berkshire is 31%. He has A's and B's shares, and then it goes down from there. I'm not a fan of this portfolio. It's not because of the companies. I haven't analyzed 112 companies, but and by the way, he did say that it's underperformed the S&P 500 over the last 12 years. S&P's returned about 15.5. His portfolio 10.8, which is huge. That is a massive difference. The problem is I just don't think an individual, and myself certainly included, can meaningfully evaluate 112 companies. I just don't think it's possible. I also think it's very unlikely to beat the S&P 500 with 112 companies. It's one of the problems that actively managed mutual funds have. I mean, the big problem is their fees, but it's hard to take billions of dollars and beat the market. I mean, Warren Buffett has pointed that out. That's one of the problems he has at Berkshire, too much capital. So to me, if you want to take some portion of your portfolio and invest in stocks, I obviously think that's perfectly fine. That's what I do. But I keep it very, very focused. I have just 4 companies. And I'm not saying 4 is the right number, but I view it as each company I add, I reduce the chance that I'm going to beat the S&P 500. You say, well, you get this concentration risk. Sure, but when you look at our portfolio as a whole, I don't really think it's a significant risk. Many of the companies in his list were perfectly fine companies to invest in, I think. I've not done an analysis of the vast majority of them, but I just don't know how an individual meaningfully manages a portfolio that has any more than a handful of stocks, honestly. I would probably put 10 at the absolute upper limit. And that's, by the way, true if I had $100 million to invest. I wouldn't put it in more than 10 stocks if I were going to invest in stocks. All right. People are saying the market's still going crazy. Is it really up that much? No, 1.5%. So Sam says S&P is overweight because of tech companies, bad for diversification. Well, this is a sort of a kind of a perspective that I hear a lot, and it's not just always because of tech companies. That's the case right now. We go back to Stock Rover. Let me switch over to it, and I'll show you. If we go back to Stock Rover, and get rid of some of these. Where did I put it? Here we go. And we look at, well, we'll look at, we can pull up VU. VTI will be similar, but we'll pull up VU. Here it is. We'll go to the table. No, we'll go to the insights. You know, you can see even for, oh, here it is. We need this one. Here we go. You know, obviously tech companies dominate the top 10. 1, 2, 3, 4, 5, 6, 7. We got Berkshire, which is not a tech company, and JP Morgan and Exxon Mobil. But other than that, I would consider Tesla a tech company, right? Yeah, I mean they absolutely dominate. But if you go back in time, tech obviously didn't dominate, but something else did, right? I mean, there's always something. You know, the top 10 companies in the S&P 500, you know, they always represent a very large portion of the index, but I don't think that doesn't really concern me, because I view the index as a way to simply match the market. And you could pick a total stock market index, and you're still going to see an overweight. You know, if we go to VTI, we're still going to see the same companies, of course. I guess Wells Fargo's in there now. Percentages are a little different, but they still dominate. But I'm okay with that. To me, the S&P 500, you're basically betting on the United States. That's what you're doing. Now, the way I deal with it is I don't have all my money in the S&P 500, right? I have some small cap, I have some REITs, I have some international. So I don't really view that as, at least for me, the fact that the top 10 companies, most of them happen to be tech right now, dominate is just not, I don't know, it's not a concern that I have. And I think if you are concerned with that, there are ways to address it by having a 6-fund portfolio, for example. Or some other kind of more diversified portfolio that might include S&P 500 or total stock market. Trap Cracker, Rob, could you do a video on leveraged ETFs, specifically TQQQ? If I believe that the S&P 500 will go up over time, why would I not allocate at least a small portion of my portfolio to it, like 5 to 10%? Well, that's a good question. So leveraged, you know, all of that is they borrow, right? They could also use, I guess, some sort of futures contracts or options. I don't know how they do it, but to basically like either 2x or 3x an index, right? So ProShares is a big a company that's into this a lot. And let me pull up. Let me see. Is this it? Yeah. So I'll just put this on the screen. I'm just going to throw TQQ. Is it TQQQ? Yeah. Let's look at this. You know, by the way, oh, this is ProShares. Yeah, there you go. See. There's something that is appealing to the idea of a leveraged ETF, right? And he or she alluded to it. I mean, if we think the market's going to go up more years than it goes down, why wouldn't we leverage it, right? I mean, so that way our average might not be 10%, but 30% or 20%. I mean, it kind of makes some logical sense, I think. Although one thing you need to be aware of is that ProShares, and let's actually look this up on their site. They don't actually look to 2 or 3x the index on an annual basis. They look to do that on a daily basis, usually. I don't know about TQQQ. Yeah, right here, 6 daily investment results that correspond to 3x the QQQ, 3x the NASDAQ 100. I haven't decided if that is a significant issue or not, but I think it's worth pointing out. This is not trying to 3x the annual performance, but the daily. So anyway, if we put that in here, it's TQQQ, I guess is going to have to clobber the QQQ, right? At least over so many years, because it's It's done so much better, right? I guess. I don't know. I don't know what this is going to look like. So yeah, ProShares, well, yeah, it's crushed it. Look at that. Oh my goodness. I don't know. I've never invested in a leveraged ETF. What's the year? So this is a 10-year period. The problem or the reality is that if we go down to annual results, so during this time, and I don't know why in the QQQ, the bar doesn't show up for 2018 because it was basically flat. The problem you're going to have, of course, is when the QQQ bites the dust, and it will, right? It'll go down big, we just don't know when, and you're going to go down 3x. And the question is, can you hold on, right? For me, it would be like, I can hold on in a roller coaster at normal speed. Make it go 3x. I'm not sure I can hold on. Maybe you can. I mean, look at the results. That's just crazy. By the way, this underscores the whole daily versus annual thing for sure. Look at that, 810 versus 72. It's like I look at this and I think, well, what have I done wrong here? There's some sort of setting I fouled up. I mean, we could contribute, I don't know, $250 a month and look at it more like a sort of a dollar cost averaging thing. The rebalancing really doesn't matter because we've only got one fund. Let's run this number. Maybe that changes things. I don't know. No? I mean, the numbers change, but that's huge. So I don't know. I can't argue with the results. I guess the question will be what happens, when things go bad. I mean, the worst year here was 20% versus basically flat, and the max drawdown was 50% versus 17%. I'm going to assume that was COVID. Yeah. But I mean, look, it's just ridiculous numbers. So I don't know. I'm not buying into that, but all I can do is show you guys the numbers. What you guys do with that, I don't know. All right. Let's see. Jerry says, Rob, big fan. Thanks for your strategy for taking out 6 months of cash rather than using the bucket strategy. Never understood it. Yeah, the more I think about those issues, the more I realize I'm definitely not a bucket strategy person. The original bucket strategy, and I mentioned this in the annuities video yesterday or whenever, day before, I guess it was yesterday, was from this guy, Harold Avinsky. But the way he implemented, as I understand it, was just, you had your investments and you had a cash bucket. That was it. And the cash bucket was for spending. And to me, I don't know, to me, that's not a bucket strategy. I mean, if that's a bucket strategy, then what's not a bucket strategy? Someone who, a retiree that doesn't have a checking account? I guess, I don't know. Maybe write checks out of a money market fund. But even that, you would just view that as your checking account. So what happened was someone took that idea and turned it into a 3-bucket strategy or a 4-bucket strategy. And I just don't think it works. The way I get over the fear of not having enough money is I look at not just cash, but also fixed income, assuming your fixed income isn't out there, meaning emerging market debt, high yield corporate debt, today, long-term bonds. Or if you had those things, I wouldn't count those for this purpose. I would look at your stuff that's safe. To me, it's, maybe intermediate in terms of the yield curve, no longer than that. And primarily either investment grade corporates or US government. And how long can I live on that? And if the answer is long enough, and you're gonna have to decide what that means for you. For me, a decade's pretty comfortable. Then I'm okay. And how much I actually have in cash for me is more really a function of just mechanics and, paying the utility bills on time and having some money if something comes up. But, that could be 6 months like it is here for Jerry. That may be perfectly fine for you. Anyway. You guys mentioned a lighting change. Was that when it went from no video to video? Because the lights themselves, I don't think have changed. In theory, I can change them with my computer, although it's not been functioning properly. Yeah, anyway. You probably want me to turn the lights down. So one per trap cracker is 5% in crypto. One thing I'd be interested in is how are you 5% in crypto? Do you just have like Coinbase and you put 5% in and buy Bitcoin and Ethereum or whatever? Like, I know they're working on ETFs. You could buy MicroStrategy, although I'm really not a fan of that company or its management. But they're basically an ETF shop, a Bitcoin company now. But if there were an ETF, that would make it easier. I guess there will be eventually. But how do you put 5% in? What do you do to do that? So LT has 10% of GBTC. I don't know what that is. Oh, Grayscale. Now, that is a Bitcoin trust. So I guess is that the closest thing, I guess, to a Bitcoin ETF that's available? And that's not in the US, right? Anyway, and 2% in Ethereum. And LT, you say you trade frequently. What does that mean? I know what trading means, but like, are you constantly buying and selling in and out of those investments? And how do you decide? Like Ethereum is what, 3,200 right now? I don't know. Let's go to Coinbase. I have a Coinbase account. There's nothing in it. Anyway, they were an affiliate of mine, like way back in the day when I owned doughroller.net. And they would give me my payout if someone opened an account was $10 worth of Bitcoin. And because I'm not a fan of crypto, I didn't do very well. I wasn't Coinbase's best publisher because who wants to open up a Coinbase account from someone who's saying that Bitcoin is not a good investment? And maybe I'm the idiot, right? 54,000, it's a big number. Anyway, Ethereum's up almost to 3,600. That's impressive. All right. The real test for crypto, by the way, and for everything to some extent, will be when the money spigot gets turned off. Rates go up, money supply goes down. That's going to be the real test. Although here lately, it's done pretty well, even while the S&P 500 has kind of been up and down. So Ethan, I mentioned how would you value crypto? He says you could value it as a payment system, similar to Visa or MasterCard. Also, remittance is the big game changer in my mind. Western Union charges a fortune, and crypto is good for unbanked. Well, there's no question that crypto is good for unbanked around the world. The problem is you need a stable crypto, right? I mean, imagine if everything's in Bitcoin and you're like, should I spend it or not? Well, when it goes up 10% every hour, the last thing you want to do is spend it. And then when it plummets, I guess you race to the store to buy bread and butter because you've just entered hyperinflation. And by the time you get to the store, it's like, wait, it's going back up. No bread and butter. Let's go back home. We can't spend it. It's going to be up by 40% before noon. I don't see how you value it like a payment system, at least not similar to Visa or MasterCard, because to me, the way you would value Visa or MasterCard is no different than how you'd value Deere & Company or Berkshire or anything else based on cash flow. And Bitcoin is it's not a currency. I know in theory it could be, and I know you can buy some things with it, but people aren't buying Bitcoin because they want to spend it. Or at least the buying that's sending the price sky high is not because people want to go down the street and buy coffee with their Bitcoin. Derek, welcome from Shanghai. It's midnight there, almost. Austin mentions he views crypto as closer to gold, and that's certainly how I think a lot of people see Bitcoin. I've got a good friend that's got a lot of money in Bitcoin, and that's his view. All right, what else do we have? Aaron asks, with bond yields so low, would the 4% safe withdrawal rate asset allocation of 60-40 still work today, or would it be too conservative? So it's a great question, and I've alluded, and maybe talked about it at different times. I think it will still work, but there's a lot of caveats to that. So we have to remember that what do we mean by still works? How would we define success? If we could fast forward, what would success look like? According to Bengen, who developed the 4% rule, success would require two things. That we take out 4% in year one, and then in future years, adjust that amount, whatever dollar amount that is, by inflation. Inflation defined as CPI. We do that, and we're able to do that for 30 years without running out of money. That's the definition of success. So how did he come up with 4%? Well, he looked at hypothetical retirements beginning in 1926, and he looked at it for 50 years. So he looked at 1926 for 50 years, 1927 for 50 years, all the way up to 1976 for 50 years. That put it into the future, by the way. He wrote this paper in 94. So for periods 94 and later, he had to use averages. But for everything else, he used actual historical S&P 500, U.S. government intermediate term bonds, and the CPI. He used actual data. And you can imagine, he didn't do it this way. Others have. But you can imagine for each one of those years saying, okay, what's the most in percentages that I could take out in year one such that I wouldn't run out of money for at least 30 years? So in 1926, if I retired January 1, 1926, let's do the math. How much could I have taken out in year one and had my money last for 30 years, adjusting each year by inflation? And then 1927. And so he did that for 51 time periods, right? 1926 to 1976, which is not 50, it's 51. I counted, I wasn't sure myself. Anyway, and there's a number for each year. He didn't actually record the number for each year. But there is, and others have. Michael Kitces has done this. And then he just picked the lowest one, the worst one, the absolute worst case. Now, someone the other day, actually it was Ben Felix, I think, who's got a great YouTube channel and a phenomenal podcast. I think he said the worst year was 68. I was pretty sure it was 66, but in any event, it was that late 60s. Why? It wasn't because of the stock market. Yeah, the 73, 74 was rough, but that didn't compare to the stock market crash. 29 to 32 was a disaster. It wasn't the stock market, which is really what everyone's afraid of. It was inflation, right? We had that double-digit inflation thingy going on in the 70s and early 80s. And because you were sort of methodically increasing your amount each year, that's what Bengen did, by inflation, you start to increase that 10% at a time. It doesn't take long for that to create a disaster. Well, the disaster was 4%. It's actually more like 4.1. And he's actually increased the number to 4.5 if you include some small cap in your asset allocation. So the real question is, when will we have a starting retirement year that, if we knew the future, would be worse than 1966 or 1968? And we don't know the answer to that, but we do know that people have taken the analysis all the way back to 1871, and the late 60s is still the worst. Could we have a bad year going forward? A worse year? Sure, yeah, anything could happen. It will require a really, really bad stock market during your first 5, 10, maybe 15 years of retirement. Let's say the first 10 probably, along with really high inflation. The reason that wouldn't concern me, well, it would concern me, but here's the reality. No one's going to blindly follow the 4% rule the way Bengen used it for his research. Who's going to see the market down for a third year in a row by 20% and inflation at 11% and just blindly take out your inflation-adjusted withdrawal? We're going to be batting down the hatches. At least I will be. I won't be spending. That's the real key. So I think 60-40 is as good as anything. I think you could argue 70-30. Bengen said you want to keep your equity allocation between 50 and 75. Actually, at one point he said, get it to as close to 75% as you can stomach. I don't know if he'd say that today, but the reason I give you that long answer is because it's important to understand all those nuances, and then you can think it through for yourself. Anyway, there you go. That's my answer. United Penguin wants to know if MSCI World is worth buying. So, which is an index. Here it is. So I wonder, does VT use this? I don't know what index VT tracks. Oh no, they track the FTSE Global All Cap Index. I don't know which funds use the MSCI World Index, or maybe that is the index fund. What I'm looking for is, do they have the allocation in here? Top 10 constituents. That looks, can you guys see that? Does that look familiar? Kind of hard to get away from those companies. Country weights, here we go. I mean, you know, yeah, I would say generally that's reasonable. I don't know if you'll be 100% in that. You have some bonds or fixed income. Obviously, it has exposure to international, which I'm a big fan of, but I understand many, including folks like Warren Buffett and Jack Bogle, were not. But I just find it hard to believe when I look back at our country and its incredible run since, we'll say, World War II, I just find it hard to believe it's going to repeat that over the next 50 years. And if it does, I'll still profit nicely. But in any event, that seems reasonable to me. Remember, there's hundreds of reasonable approaches to index fund investing. The key is not to jump from one reasonable approach to another, to pick one and stick with it. You know, I'd mentioned in a previous video, I'd really love to have just a 3-fund portfolio at this time, and there's pros and cons to that. And I can't get to it for a number of reasons. One of them is taxes. But the other reason is I have a 6-fund portfolio, which I like a lot, and I just, you know, I've just decided I'm not going to change. For me, it's a bit of a headache to manage it, but I'm just a big believer in not jumping from one reasonable allocation to another. Now, you know, there could be circumstances that would cause you to change and might cause me to change, but I really change very, very slowly. Sam asks if I'm familiar with fundamental indexing. Created by Rob. All right, let's see. I have seen this book. I've not read it. Here it is. I'll check it out. One of the things I want to start doing on the show is, I guess I'll call it book reviews, but where I've read a book and I just kind of boil it down for you in a video, you know, a 10-minute video or whatever. And I'll do that, but I'll definitely get that book. I've not read it. Christopher wants to know, is Stock Rover a free service? It is not. They are also an advertiser of mine. I don't really talk about them much. I use them. I use Morningstar. These sorts of companies, because my show is not like a trading show, like if I were like a day trader, I could probably make a fortune on tools like this by showing people how to use them. But when you're an index fund investor, it's like, you know, what'd you do today? Nothing. I looked at the market. What trades did you do? I didn't do any trades. Well, how about this year? No, none yet. Anyway, Stock Trader does cost some money. I think you can get a free trial. Yeah, there's a free sign up. Let's see if it tells you what it is. It does not. Oh, 14. You can get a 14-day free trial. So there you go. But it's not free. They have different, they have a free plan. What's the free plan? Oh, I think that's just the 14 days. And then you can get it for as cheap as about $8 a month. You can get it a little cheaper if you pay by the year. Yeah, Morningstar, it's this funny thing. So Morningstar is an advertiser of mine, and I've made almost nothing, like a couple $100 maybe. And the reason is, I don't think most people need the premium version of it. And that's the only way I make money. So when I did my whole Morningstar thing, I wasn't really pushing the premium because, I mean, some people it makes sense, I suppose. And I've had the premium version for a long time, but I write about this stuff. But most people don't need, from I think 99% of the people, the free version is fine for Morningstar. Stock Rover is interesting, and I can show you some things it does in another maybe in another video. One of the things, I will say this, its portfolio is much easier to manage. Morningstar's portfolio tracker, great information, but it's a pain in the butt to deal with. And I'll just show you this real quick that I like about Portfolio Visualizer. So you can put in portfolios, and actually, let me just do something here real quick, and then I'll turn the, so like here's the David Swinson portfolio, Warren Buffett portfolio, Rick Ferry 3-fund portfolio, and a lot of these are already pre-programmed into Stock Rover, and they have a bunch. If you go down to the library and you go to portfolios, there's all these different portfolios that you can look at. You can compare your portfolio to any of these. So that's kind of pretty cool. So I've spent some time playing with this. There's Paul Merriman. They have his portfolio. Different ETFs. If you want to like focus on growth, and of course you can create your own. And then kind of like what I did in Portfolio Visualizer. Although you get a lot. Well, they both tools give you a lot of data. So anyway, I like Stock Rover. Again, I think for a lot of people, you're just not going to need that kind of tool. And for those of you that do, you're probably willing to pay a little bit of money for it. Let's see. So James asks what I think about structured notes. And the truth is, I've not focused on structured notes. I don't have an opinion at all. But I'll check it out. Maybe, I'm sure if I study them, I'll have an opinion. All right. Whoops. What else we got? Neil, you're welcome about VTI VGT. The mega backdoor Roth issue has not gone anywhere yet. It's still just a proposal out of the House Ways and Means Committee. Sean mentions that the book on the Pennsylvania retirement system. Apparently, they're working on a book for every state, which I think would be great. I don't know, man, that's a lot of work. Good for you guys. Sai asks, hey Rob, quick question. Would it be safe to take out a put and call option on a concentrated stock position to help hedge against potential volatility in the stock, since I believe long-term not so short? Well, that's sort of an open-ended question. Generally, I view if you're buying options as insurance, right, as opposed to selling a call option because you want to make the premium. But if you're buying options for insurance, I have the same strategy I do with car insurance or life insurance or high deductible health plans. I don't want to buy insurance unless I absolutely have to. So I prefer to invest in a way that allows me and to manage my finances as a whole that allows me to not hedge. So none of my long positions are hedged at all, nor have they ever been. And I think that's the best way to approach it. Yeah. I mean, if you're like a pension or a company and you've got some short-term issues, there's certainly reasons you might hedge something. You might need to deal with currencies down the road as a company, and you're going to need a couple billion euro 6 months from now. You probably want to hedge against the risk that they go up vis-a-vis the dollar, right? But I mean, for you and me, I just would prefer to invest in a way that doesn't require me to spend money buying options. By the way, on the HSA front, Christopher had a comment here. I know that we talked about it a minute ago. If you have this through your employer and they put money into your HSA, you definitely want to have your HSA through them because for two reasons. At least in my experience, they won't contribute if you open up to an HSA on your own somewhere. But also, any contributions you make not only avoid the income tax, but they also avoid the payroll taxes. If you open up an HSA on your own and contribute to it, you'll get the income tax benefit. But of course, since you're not contributing it through your paycheck, it wouldn't help you in terms of your payroll taxes. Now I have an HSA, my wife and I both do, separate from my employment situation, but it contains money from past employer HSAs. And I moved them out of that HSA because it required me to keep a certain amount in cash. And I don't want that. I want to invest it all. So there's a couple that allow you what they call first dollar investing. Fidelity is one of them. Joe, what's the name of the financial advisor you talk about? The one I talk about is Mark Zorel. And every time I talk about him, I mention I have no financial relationship at all. He's not an advertiser. I don't have any financial advisors that pay me anything. But I've been happy with Mark. It's all online. I don't know what his cost is now. By the way, a lot of people have asked me about investing when expats, or you're going to move out of the country. He actually does a lot of that work, if that's you. But yeah. Mike wants to know if I can do a video on alternative investments accessible to the public, such as Yield Street. Sure. Let me just make a note. And I was at a conference, Yield Street was there. Acre Traders was another one that was there, where you can invest in farmland that I'm taking a serious look at, because that, to me, that's pretty significant diversification. Let me just make a note. Alternative investments, got it. All right. Ethan wants to know what class of equities to hold in a taxable account. If you're holding something like, a Vanguard S&P 500, a VTI, total market, that kind of thing, they're incredibly tax efficient. By the way, the mutual funds are too. Not all mutual funds are, and there are some differences between ETFs and mutual funds from a tax perspective that can be important. But for like a Vanguard fund, I think they're all very tax efficient. With international funds, the one thing you have to keep an eye on is whether or not any of your dividends will not be qualified. And I don't know if like the Vanguard prospectus tells you that. I'm not sure, but it's a question to consider, because if they're not qualified, then they get taxed at ordinary income, and I get hit with that every year. It's not a huge amount, but it's annoying. Here's an interesting question. Christian, do you still carry the Chase Sapphire Reserve now that they increased their annual fee by $100? I do not. And in fact, if I were to pick a Sapphire card today, I would pick the preferred card. Although I heard they had a 100,000 mile or point bonus that I'm not sure if that's going away. I don't know. Let me just look it up real quick. No, right now it's still there, so maybe I misheard. Anyway, it's I think it's $95 annual fee. Yeah. What happened was we're just not traveling as much, and I'm using other cards more. And it's $550 plus they wanted another $75, I think, for my wife's card. It just wasn't worth it. You do get a $300 travel credit and some other things, and your Chase Ultimate Reward points are worth a 50% bonus. With preferred, it's just 25%. And so I had them actually convert it to the Chase Freedom Unlimited card, because that's 5% cash back on all travel booked through Chase Ultimate Rewards. I'll probably use that more. Now, in theory, what you could do is get the Chase Ultimate Rewards, or Chase Freedom Unlimited, get your 5% back on travel booked through Chase Ultimate Rewards, and they have other rewards categories as well. And then if you have preferred or reserve, transfer those points to whichever Chase Sapphire you have, because then you'll get the advantage of either the 25% bonus with preferred or the 50% bonus with reserve. You'll see that called the Chase Trifecta. The trifecta is a Sapphire card, a Freedom card like Unlimited, and then a business. If you have a small business, even if you're just a solopreneur, the business card. I don't have a Chase business card at the moment, but I'm somewhat disturbed that I know so much about credit cards. It can't be healthy. Huh. Austin says, Rob, have you heard of Wisdom Tree ETF called NTSX? It's 90% S&P 500, but with 10% collateral for 6x leveraged bonds. So it works out 1.5 leverage 60/40 fund. Of course, I've heard of Wisdom Tree. I haven't heard of this specific fund. I'll show it to you guys. There it is. Let's put this in the old portfolio visualizer, and we'll compare this to VU. No, we'll use SPY. It's got more data, I think. It's interesting. Of course, it's so. It's the final balance is the same. How much time do we have? Yeah, it's only a couple of years. This must be NTSX is new, so this is basically worthless. What I was going to say is their final balance is the same, even though NTSX has it's leveraged bonds. It does, at least in the 2 years data we have, which is really not much, it does show a slightly lower standard deviation and a lower max drawdown. But I'll check that out. I don't know much about it, and 2 years of data is just not much. Let's see what else we got. Joe asks, any thoughts on Joel Greenblatt's magic formula investing? So I'm not, let me just make sure I know who we're talking about. I'm pretty sure I do. Isn't his daughter, maybe I'm getting it wrong, isn't his daughter? No, this may be someone else. Oh, he's Gotham Funds, that's right. I'm going to add this to my growing list of videos, because that would be interesting. I don't have a comment. I don't have an opinion. I thought it was someone else. But by the way, anytime someone says they've got a magic formula, red flags go up. It's like, yeah, okay. I've never ever heard Warren Buffett say he's got a magic formula. So David asks, would you adjust your long-term asset allocation percentage based on valuations for the market? For example, moving from 70-30 to 50-50 until things return to normal. I thought about that in response to Justin's question that I talked about at the beginning of the show. For example, I thought, well, maybe for each 5 in PE, it goes up, say from 20 to 25, I lower my stock allocation by 10% or do it that way. But again, I probably wouldn't. I might do things on the fringe, like focus on like a Schwab dividend ETF that's got a lower valuation, maybe. But I'm not going to, I don't think the problem is I get concerned. This is more of a way to keep myself honest. I get really concerned when I start making changes to stock bond allocation because of the market. There are other good reasons to make changes, as you near retirement and so on. But I probably wouldn't. Plus, for me, there'd be tax consequences that would get in the way too, because most of our money is not in retirement accounts. Sam wants to ask me if I can do a video on how to evaluate a company. Sure. I think I might already have this in here. It's not. Some people promote their magic investing formula. I don't think what I do would be described by anyone as magic. Salty wants to know, what are the pros and cons of in-process 401k rollovers? I think so. I've heard this as in service, but I think what you're asking is the ability to roll over a 401k while you're still employed. So I mean, this is sort of what they use with the mega backdoor Roth, right? So that could be as part of a mega backdoor Roth if this is after tax money. That wasn't your question specifically, but that obviously could be huge advantages there. I'm trying to think what the advantages would be. I mean, if you didn't like your 401k and their investment options, and you could roll it over into an IRA. That might be one reason to do it. Other than that, I guess the question would be, why do you want to do it? That's the only advantage I could think of. Is there, maybe they just don't have very good investment options. Christopher wants my thoughts on investing in Berkshire Hathaway. I don't hear a lot of people investing in them, but it seems like a good place to invest and very diversified. Well, I'm an investor. I own B shares, and I've been to the Berkshire Hathaway meeting. It's been a couple of years now. Well, of course, they haven't had it the last two, at least not in person. I view it as basically a large cap U.S. mutual fund with a couple of advantages. It's actively managed. That's not the advantage. What is it? It is the advantage when it's being actively managed by Warren Buffett. And yes, I know he hasn't outperformed technology. I'm old enough to remember when he got criticized over and over again because he wasn't invested in .com. Those criticisms died down around 2001, as I recall. But he has a couple of advantages. One, there's no fees, right? I mean, I guess you could say, well, the cost to run his operation in Omaha is a fee, but that has to come out to like 1 basis point less. I don't know. I mean, if you've seen their website, look at their website. I love this website. Oops, that's not it. Hang on. Here's their website. Isn't that great or what? But the other advantage they have over a mutual fund, in my view, is that Warren Buffett can buy private companies, whole companies. They don't have to just invest in the public market. So they buy companies. And so they have a lot more available to them. And also, for everything that they own, the companies they own whole, railroads, utilities, Geico, and the dividends they get from the stocks they own, Warren Buffett and his team can allocate the capital. And they're not perfect, and Warren Buffett would be the first one to tell you that. But I don't know of any that are better. So I think Berkshire is a great investment. I'm very happy with owning it. I don't own a lot relative to my portfolio, not for any particular reason that I can think of. Yeah, so I think it's a great investment. In fact, I probably should add to my Berkshire holdings. All right. So Victor wants to know, does it make sense to build a cash position by taking some profits on an upswing and then reinvesting the cash on pullbacks of greater than 10% from its highs? It seems like we get at least 10%. Well, so profits on an upswing. What's an upswing? So you need to define that. You've defined the pullback. It's got to be 10%. You got to factor in trading costs, taxes. If it's in a taxable account, will kill you. Because you could have a lot of short-term gains potentially. But whether that would do well, I mean, at the end of the day, what's going to really matter is what you're investing in. And my approach is just not to be an active trader. I like to buy things that I think I can hold forever. And I think that's the best way to invest. Could you backtest some strategy that has done well? Probably. I don't know what that would be, but I'm sure you could. But I suppose if you were going to do this, you'd need hard and fast rules to keep your emotions and, subjective opinion, not subjective, but I just say your emotions out of the equation. It's one reason why you should also have a planned rebalancing schedule. It can actually be no rebalancing at all. There's an argument for that. It can be once a year. I'm working on the video on opportunistic rebalancing. It's really pretty simple. But you need to have a rule, whatever it is for you, so that you don't let your sort of views of where the market is and where it's going to go cloud your judgment. Favorite phone app for reviewing stocks? I don't know that I have one, Christopher. If I want to review a stock, I'm doing it on my computer. I mean, M1 Finance isn't bad just to what it is, but you're not going to get a ton of stock research. Oh, wait, there is one. Its name now escapes me. I'm I'm trying to see if I've got my phone with me. Oh, yes, I do. Hang on. I've got it right here. I'll have to, I don't remember what it is. I will try to figure that out. It's funny to get your comments like 10 minutes after I talked about the issue, but you guys are not fans of leveraged funds. Yeah, I guess for the same reasons I'm not. By the way, while I'm looking for the next question, I know some of you enjoy this. Others of you probably think I'm insane. But I got to put a chess problem up on the screen, right? Now let me just tell you about something here, and this is serious. So my rating for puzzles is 2875. If I get a problem right, I get points. The minimum is 5 points. I can get more than that if I solve it quickly. When I do this on this show, of course, I don't solve it quickly because normally I just put it up there and let you guys figure it out. These problems are really difficult. My goal is to get to 3,000. And I've been hovering in the 2,800s for a while. So I could really use your help on that. What's the best move? Black to move. That actually, it doesn't look very hard at all. Unless I'm missing something. Anyway, I'll let you guys ruminate on that one for a while. Oh, here's a good comment from Igloo. My friend had 300 Bitcoins. I texted him congrats when it was 17,000. He sold it when it crashed to 8,000. LOL. That's the tough thing, is knowing when to buy, when to sell. All right. Oh, I see. So I see some answers. My initial reaction when I saw the problem was Queen E2, because the king's got to move to G1, and then I back rank mate him with Rook B1. The only thing he can do is interpose the knight. It's like, I don't know what I'm missing. Let's see. Sometimes I think it's so easy and I move the piece and it's just dead wrong. Yeah, I mean, and actually this is a weird puzzle. I guess I can't move the rook here, right? Because the queen would take it. But I can just move my queen here. It's the same thing, right? What am I missing? Oh, there you go. See, and I got my 5 points. All right. I'll put one more up there for you guys while I look at the questions. Don't let me down. I need help on this one. I don't want to lose my points. Christopher, the person I mentioned who has a good YouTube channel, I'm going to take the chessboard off for a moment, is Ben Felix. He's Canadian. So I don't know what that means, but here he is. He has a great YouTube channel, very popular. His are sort of, as you can tell, mine are casual, sort of conversational. His are more scripted. Here's one on the 4% rule. That's not Ben Felix. That's Nathan. I don't know who Nathan is. There we go. There's Ben. I don't know if you guys can hear him, but good graphics. I need to up my game. And his podcast is the Rational Reminder podcast, and he's got a co-host. But here it is. I really like this podcast. See, he's even got the Canadian leaf there, so he's got that going for him. But no, seriously, really good stuff. So, and I, in the YouTube world, it can be very competitive. I don't really get into that. But my view is if there's people out there putting out good content that can help you guys, or you just find interesting, I should share it. And I think he's terrific. All right, back to the chess problem while I find the next question. CG London wants to know, what are your expectations, if any, of crypto if we get one, higher inflation, or two, lower than expected sell-off rally, something else? Well, Bitcoin has been highly correlated to the S&P 500. Now, that's not always true, and it doesn't mean it'll be true in the future. And it's done some things here lately that I think, call that into question. The question I have is, when we have higher inflation and higher interest rates, how patient are people going to be invested in Bitcoin when their money just sits there and doesn't do anything? That's the question I have. And so I suspect Bitcoin will, if I had to guess, and that's all this is just a guess, I would guess that it would go down. But yeah, I don't know. Felix wants to know, Rob, what do you think of a money market fund that yields about 5% over bonds? I would be very suspicious of a money market fund that yields 5% over bonds. Felix, do you have a ticker? In fact, I don't even know that that's legally possible, assuming it's a US money market fund, because those are heavily regulated, and I'm not sure what investment they could possibly have that would generate a yield 5% over, say, I don't know, the 10-year treasury? I don't know which bond you're referring to. So if you have a ticker, I'd love to look at that. I'll pull the chessboard off. I assume you guys have got an answer for me. I'll get down to the comments here in a minute. Double Dog Blitz, do you think the market will continue to move higher? I have a prediction. I think the market's prices will fluctuate. That's my answer. And if so, why would we have bonds at all? With the way government handles money, not sure if I would want to give them any more than I need to. Well, I guess indirectly you're giving the government money. I mean, you're buying bonds in the market, on the secondary market. Well, you could be buying bonds directly. I guess you could log in and buy a bond. By the way, I've read that when the rate adjusts in November, it could be like 6 or 7% on an I bond. So, that's a big question. I mean, I won't pretend that it's not a real question. We're approaching 30 trillion in debt. It appears that we're going to go into more debt one way or another. It doesn't matter which party is in power. It matters in terms of how we go into more debt. And what causes us to go into more debt. They have different views on the role of government. I'm not here to say which one's right or wrong or whatever, but we're definitely going into more debt. I think that's a given. And eventually, when it costs us more money, it's going to hurt. And I don't know how we'll handle it. I don't so much worry about the bonds per se. I mean, the yields are very low, which means the bonds are very expensive right now. That's a reality. But I think, you need that stability in your portfolio, at least if you're near or in retirement. That's my view. I mean, if you're in your 20s or 30s or even 40s and you want to be 100% stock and you can handle the volatility, I can't argue with that approach. Sarah wants to know, what are your thoughts on option trading, mostly open option selling? I have a $500,000 net worth and have half in index funds and the other half in a brokerage account dedicated to option selling. I'm 30. Well, number one, congratulations. If you're 30 and you got $500,000, that you're doing pretty good. I have yet to meet someone who consistently makes more money trading options than they would if they just invested in the index and left it alone. Maybe you've got the magic formula or the magic touch. But I've yet to meet anyone that does. You also say you're considering taking it out of the brokerage account, putting it all in index funds. I mean, I'd be curious what your track record is. The problem, it's very hard to know your track record, actually, I think. Maybe there are tools that can tell you this, but if you sell calls, so you could what, sell to close? I think that's the right way to think about it. If to avoid getting your options, your stock called away. But like if you have, I have friends that trade options a lot. We talk a lot about this, and one person in particular, he's had shares called away. So the way a call option works is you sell someone else the right, but not the obligation, to buy your 100 shares. Each options contract covers 100 shares of whatever, Apple, at a given price. So let's just say they're out of the money. I think most people that do this feel more comfortable selling calls that are out of the money. So let's say if stock's trading at $100, you're going to sell a call option. The strike price is 110. You get $1. I'm just making the numbers up. You get $1 for your per share for your premium, and it expires in a month or whatever. Well, let's say the stock goes to 120, and your shares get called away. In other words, the buyer of the option exercises the option. Says, "Yeah, I'll take those shares for 110 that are now trading at 120." I've yet to meet an options trader that actually tracks that as a loss. Yeah, I lost big, because you did. You lost huge. But they don't see it that way. They're like, well, I got my $1, and yeah, they got called away, but I made $10, called away at 110, so I made 10% in a month. That ain't bad. They don't see that as a loss, and I see it as a huge loss. Anyway, I don't know. Have you had success selling options? I've yet to meet someone that, honestly, I've yet to meet someone who could actually tell me. I've traded options for 3 years, and this is exactly how I've done. I'm sure they're out there, and for you options traders listening, I know you're going to come into the chat and give me what for. That's okay. So Salty adjusted his question about in-process 401 conversions to Roth. So again, I don't know if this is a mega backdoor where you're converting after tax 401k contributions. If that's it, I love it. I wish I could do it. I've never had a 401k that would allow it. If you're just talking about you want to do a Roth conversion, so you roll over your traditional 401k to a traditional IRA and then convert it, I mean, I guess it's just a question of whether the conversion itself makes sense. The fact that it came from a 401k, I'm trying to think why that would matter. I can't think of a reason. What else we got? Ethan wants to know, Rob, are you still doing CrossFit? Now, finally, a question, the best question of the day. I wish I had like a prize to give you guys. So I've never done CrossFit, the brand. So my story is, I hurt my back in college playing basketball, intramural basketball. I twisted. It was a weird thing. I'm up in the air, I twist, pop, hobble off the court. I was at Ohio State. I was taking summer classes there. And the next morning, and then I re-injured it again playing softball. I swung the bat, hit the ball. I got to first base safely, but it cracked all the way up. You heard it like 5, 6 crack, and I hobble to first base. The next guy hits it to like the shortstop. I hobble, of course I get thrown out, but I hobble to like second base. I turn and I say, I'm going home, bring my stuff. And I literally hobble through left field into the parking lot, drive home. The next morning, it's a summertime, so I didn't go to Ohio State. I didn't graduate from Ohio State. I was just home for the summer, taking some courses. And I was living in our basement. I don't remember why. And I literally couldn't walk the next day. Ambulance had to come. 3 guys that were out of shape and old with a stretcher come down the stairs with the ambulance. They cart me out, take me to the hospital. This is before MRIs. They take an X-ray. X-ray's fine. He gives me some pain pills, and I think I went home laid on the couch and watched some Supreme Court nominee. Was it Robert Bork? When was Robert Bork? I actually ran into Robert Bork. He's passed away now, I'm pretty sure. Yeah. At the Boston airport years ago. It may have been his. What year was he? I don't know. Anyway. My back got worse and worse and worse over the years where it would go out on me and I couldn't walk for a week. And I was getting ready for a trial in 2010. I was at the Public Company Accounting Oversight Board, and my back went out on me. I'm trying to swim. I've done acupuncture, cupping. They put the suction cups on you. Dry needling. They stick the needle right into the muscle. Electric stem. Anyway, my physical therapist at the time said, I'm going to this gym, you should go to it. The gym is called Underground Athlete here in Northern Virginia. It's owned by a Marine, former Marine. And I started 10 years ago, 11 years ago, and I was doing a Romanian deadlift. So ignore my form, but all it is, usually you use a bar. You're going down like this, right, with a bar and then standing back up. I was using 2 kettlebells, 8K. So we're talking like 16 pounds each. They're pink. And my back went out on me. This is like the first week I'm there. So I was out for a week. I went back in, and he, I wish I could show you this. You won't see me if I lay on the floor. I did these things where I would lay on my back, straight out like this, my arms out like that, and my job was to roll onto my stomach without using my arms or legs. Which, to do that, what do? You engage your core, because that's all you got left. And then I'm on the turf in his little gym. I'm on my face. Then I can use a little bit of leg, but I have to roll back over onto my back. That's where I was. That was my level of fitness. Of course, all the guys are in the gym. They're benching 225 and deadlifting 4 plates or whatever. And there I am rolling over. But that's all I could do. That's how bad it was. And 10 years later, I've lost. Well, I weigh about $1.85. I probably weighed 2.25 at one point. And I just slowly got better. And my back has not gone out on me since that Romanian deadlift. The one thing that I really can't do is any sort of traditional deadlift. That's my Achilles heel. I've used trap bars that are elevated. I've done rack pulls. Even I love kettlebells, but even like a heavy kettlebell swing will mess my back up, which is really a deadlift for those of you that are into this sort of thing. But I have my own gym. I should maybe do a live stream out there and I can show it to you. But it's a Rogue rack. I have 3/4 inch stall mats on the half of my garage that belongs to me. Rogue weights, pull-up bar, kettlebells, bumper plates. And they still give me my workouts, they being Underground Athlete. So I'm still with them. And so my last workout was, I did some ankle mobility, then I did hard plank. So you get into a plank, but then you squeeze everything for like 10 seconds. I did a back squat. I can do a back squat. I don't put a lot of weight on there. I think I was up to like 150 pounds, which is really not that much. But I did a 1-arm floor press with an iso hold. So I'm doing a floor press, but I'm holding weight in the other hand while I do it. Pull-ups. 3 sets of 6 to 8. When I started, I couldn't do a single pull-up. And these are dead leg pull-ups. They're Marine style pull-ups. Calf raises and reverse crunch. That was my workout on Friday. I did Blackburns the day before, which is a shoulder mobility exercise, dead bugs, one arm core trainer press, with a barbell. Sissy squats. I'll let you Google that one. They ain't for sissies, though, I'll tell you that. 1-arm row, hip lift off the floor, push-up shoulder touch is a good one, right? You do a push-up, and then while you're in the up position, you slowly, or as slow as you can, touch, just good core exercise. Anyway, so yeah, I'm still doing it, but not CrossFit. I've never done the branded CrossFit. So, Mr. Brain, he says, Rob Berger, hello, first-time live stream viewer, is investing a small weekly flat rate amount of cash into small companies viable to build a portfolio that will be sustainable for a 30-year time frame? Well, a couple things there. So, is investing a small weekly amount? I think absolutely. I don't know what small means to you. If I were getting started and I could invest $5 a week, that's what I would be investing. If I could invest 50, that's what I would be investing. I think when I started outside my 401k, It was $100 a month, Legg Mason Value Trust. I set it up on an automatic thing, and they got around the minimums with that. So I'm a huge believer. It's one of the reasons. In fact, let's check out my. I'll just show you this real quick. Let's see how my M1 Finance is doing. This is where I invest credit card rewards. Which most months is not a lot of money. And let's pull it up. Oh man, I'm almost at 30,000. $29,858. And I have some more contributions to make from last month that I haven't done yet. I just put mine in 2 banks. Anyway, so I'm a big believer in investing small amounts of money over long periods of time. What you invest in, you say small companies, so I don't know what that means. I mean, I know what a small company is, but I would need more specifics. I would tend to think just put it in an index fund for most people. But and then to build a portfolio that will be sustainable for a 30-year time frame, well, whether a portfolio will be sustainable for a 30-year time frame depends on a lot of things. We've talked about them, how much you pull out of the portfolio each year during those 30 years, how you adjust that amount each year, how often you adjust that amount. There's a lot of factors that go into that, so I don't think that's sort of an easy answer, at least the way I understand the question. But I'm a huge believer in investing right now whatever you can. I understand there are other priorities. You got to pay off your debt if you have any. You want to buy a house someday. Maybe you're saving for a child's education or whatever. Those are important. I think we can multitask. I'm not a believer in just focusing on one thing and ignoring everything else. I know there's some other guy out there in the world that thinks you should just do one thing at a time. And by the way, if just focusing on one thing at a time works for you, I'm not here to try to talk you out of that. I don't know what you guys are talking about with Coke and Kentucky Fried Chicken, but whatever. Fossil says, hey Rob, love your videos. Buying ETF every month and doing DCA is best investment strategy compared to lump sum. Well, I've got a whole video on this. I've talked about it. I think a lot of people right now are uncomfortable with lump sum because of stock market valuations. And so if you've got a lump sum and you prefer to stretch it out over 6 or 12 months, I'm not here to tell you you shouldn't do that. Historically, lump sum has actually outperformed rather than, say, stretching it out over 12 months. But that's just because odds are the market will be up. It's up more often than it's down on an annual basis. At these valuations, I'm not sure that would be true, but I haven't done the analysis. But there's 100 other questions that are, if you got a 100,000, I'm just making up a number, $100,000 bonus, and your question is, should I invest it all right now or stretch it out over 12 months? There's 100 questions that are more important than that one. Pick one that you can live with, because really what you're asking me is which option will turn out better. There's no way to know. I don't know. There's no way to know. Kyle and Emily, 32-year-old teachers and with future pensions, and also contributing another 25% into retirement accounts. Increase Roth 403b contributions or use that money for a limited purpose FSA. So I have to confess, I don't know what a limited purpose FSA is. But it's a thing apparently. Huh. A limited purpose FSA is a flexible spending account that is compatible with health saving accounts. A limited purpose FSA is referred as this because it is used to pay for eligible dental and vision care expenses only. Now that's from WageWorks. I assume it's accurate. I don't know. I guess my question would be, if that's an accurate description of what a limited purpose FSA is, it kind of strikes me a little unusual to be comparing that versus a 403b contribution. They seem like they're two totally different things. I mean, do you know you're going to be needing to spend money on dental and vision? And a limited purpose FSA will help you do that in a tax efficient way? Then that might make sense. But literally my knowledge of a limited purpose FSA is what I just read you. I never heard of them before. Well, you learned something new. Where do I find the correct CPI when implementing the 4% rule to figure my retirement distributions? Well, let's see if I can give you a website. Here we go. Well, this is perfect. This is the Federal Reserve Bank of Minneapolis. I'm going to assume that their CPI figures are correct. And it starts in 1913. One thing I want to show you as we move down in time, 1930, look at these negative numbers. Minus 2.7, minus 8.9, minus 10, minus 5. If you had lived during that time period and you were using the 4% rule, the amount you took out each year would actually go down. That is why this time period outperforms the late 60s. The stock market was down a lot more from 1929 to 32 than in the 70s. But this saved you, so to speak. I don't know if living through the Great Depression would, be a picnic, but anyway. All right, let's move on down, see what we got. An estimate for this year is 4.8. Wow, you can't even see that. Let me make this, well, it's a little bigger. Anyway, it's 4.8%. That's the estimate for 2021. Last year it was 1.2. So you could use that. I would also, though, ask you, if I were doing that, I would also ask, though, do I need the raise? I mean, or maybe just a question. But yeah, you could use that, Marlene. I think that's a good website. And I think I just Googled CPI by year. That's what I Googled. Bogdan asks, he says, I really like your videos. Could you please suggest one or more bond ETFs from iShares? I don't know any off the top of my head, but yeah, we could. So, this is how I do it. I would just Google iShares bond ETF. Let's see if they have a list. Their funds are here, but I would assume they have a list here. Maybe they don't. Getting started. So here we go. They have several right here. So I'm guessing something like this. And here's what I would do. I'm going to show you how I would evaluate this if this is what I was trying to do. This strikes me as something not unlike Vanguard's BND, but I could be wrong. So I grab the ticker, which is AGG right here. I don't know how well you guys can see that. And I would put it in Morningstar. You could use Stock Rover as well, but for this kind of thing, I think Morningstar is good. And we know the expense ratio is low, 4 basis points. It's a U.S. fund, intermediate core bond. So intermediate means the maturity of these bonds it's not short term, think a couple of years or shorter, say 0 to 5. It's not long term, think 10 or more years. It's in the middle. Probably, I'm going to just guess the duration of this fund is somewhere between 6 and 7. And we can figure that out by just going to portfolio. By the way, let me know if this kind of thing is helpful. Guys, we've been on this call almost 2 hours. We still have, and I haven't forgotten about this chess puzzle, that the clock is now 25 minutes. So if I get this wrong, I'm going to get crushed. Anyway, look at that, effective duration, 6.53. So that means if interest rates go up by 1%, the value of this fund will go down by roughly 6.5%. And its credit quality is in the middle, so we can look at what it, so it's basically an investment grade bond fund, meaning there's no junk bonds. They're BBB, triple B or higher. Yeah, and this is like BND. It's got government bonds, it's got some corporate bonds, and then it's got some securitized, which would be mortgages. I'm guessing if we look at BND, it's very, very similar. Go to portfolio, may even be based on the same index. Well, this is a higher duration, not by much, but but it's all BBB or higher, roughly the same kind of allocation. So that's what that is. And so to me, that would be a perfectly reasonable bond fund for like a 3-fund portfolio or a 6-fund portfolio. But there are others. So like this one is all investment grade corporate bonds. The yield is going to probably be higher. Let's look at yield. So we're back to the original fund we looked at. Its 12-month yield is 183, right? If we then look at the corporate bond, LQD, I'm going to guess the yield is higher. Because it doesn't have government bonds and securitized, it's corporates. Yeah, so the yield's a little higher, 2.37. And the portfolio, let's see what the duration is. So it's higher. So this fund exposes you to more interest rate risk. If the rates go up by 1%, this fund will go down in value by roughly the duration, 9.74%. That changes. It's not exact science, and it's all corporate. But it's all investment grade, so there's no junk bonds in here. So this could be an okay option, or you could do a little of both. And then you have others, ultra short term, right? So you're not going to have interest rate risk, but your yield's going to be a lot lower. ICSH, we can look at it. Yield's going to be certainly under 1, right? Yeah, 49 basis points. And its more recent yield over the last 30 days is 24 basis points. But its duration is going to be a lot shorter, maybe 2 years or something. Oh, it's really short, just less than a year. So this has virtually no interest rate. This is almost like a savings account. That's how I would view this. So anyway, I hope that helps. You can look at these others. There's Emerging Market Bond Fund. But that's my take on it and kind of generally how I think through bonds. Obviously, very quick take on it, but that's how I would look at that. Mike wants to know if the solo 401k qualifies for the 55 rule. Well, I don't know. So I'm just Googling solo 401k age 55 rule. The age 55 rule, by the way, is if you're working at a job and you retire in the year you turn 55 or older, you can start taking your money out of the 401k that's at that employer without the 10% penalty. Looks like you can. Oh, wait a minute. So you can't be employed by the company, right? You've got to quit. So like if you're the only employee of your company, as a practical matter, you might not be able to quit. That's what it's saying. Here's what I'm looking at. This article from solo401k.com. So you can check that out. I just Googled solo 401k age 55 rule. Salty mentions that in terms of the in-service rollover, so it was to get better options in an IRA, and that makes sense. It makes sense that they wouldn't release the matching portion, maybe. There also, I would question if there's vesting issues, how that would work. Yoon asks, what do you think will happen to the stock market with a huge influx of index funds? Even not so great companies are getting bought for the sake of being in the index. Well, that's kind of true and it's not. I mean, it's a cap-weighted index. So the vast majority of the money are going to the largest companies, and they're pretty good companies. And this issue, though, has been an issue for years. You're not the first. I mean, I've heard this for 20 years. And I'm not saying it's not a theoretical problem as more and more dollars are passively invested. I think in theory it could create some issues. I don't think we're there yet, and I'm not sure what that would look like if we'll ever get there. So I think the question is actually a good one. But my concern is not so much that the index will buy companies that aren't so great. Why? Because that's always been the case. That's just by definition what you get when you invest in an index fund. You get good companies and you get bad companies. And so that's nothing new. And the index funds have still outperformed, at least certainly large cap US funds, actively managed funds, pretty handily. Let's see. Well, so Sarah wants to know if I could go back in time and be 25 tomorrow. That's a pretty serious time machine. How would you invest? Well, I mean, if I know what I know today, how would I invest? I mean, that's kind of an unfair question. But let's assume I didn't know how any single company was going to perform. But I know what I know today. It'd be index funds. Salty wants to know, how do you feel about sticking your entire portfolio into a hedge fund? I would never, ever do it for a lot of reasons. Don't like the fee structures, don't generally like their approach to investing, and I don't want to give up control. All right, what else we got? Paul Merriman suggests DFA funds over Vanguard funds. What are your thoughts on this? Well, you can't invest directly into DFA funds. You got to have an advisor. So for me, they're out. This used to bother me a lot, like 20 years ago or something. It doesn't anymore. I like DFA. They've got some great funds, but I don't lose any sleep over the fact that I can't invest in DFA funds. DFA now has ETFs. Are they publicly available to anyone, or do you have to buy through an advisor? In the past, you've always had to buy through an advisor. Although if they're an ETF, they couldn't limit that, could they? Well, hang on, let's find out. There's one easy way to figure this out. I'm going to go to M1 Finance. We'll look at U.S. Core Equity 2, DFAC. Well, you guys have just rocked my world. I'm going to have to start looking at all these ETFs. But can I actually buy it? I guess I can. Although all it allows me to do is add it to my, well, hang on. See, now you've fired me up. Let's see here. So we're back to, what happened? Hang on. Huh. Oh, here we go. So we're back to my M1 Finance. These are all the pies I've created over various times. We're going to create a new pie. And we're going to put in DFAC, add to basket, add. We're going to edit it, DFA. Huh. How about that? Yeah, I did not know that. So I'll be doing some DFA research. I'll work on some videos on that because they do have good funds. All right. Here's another question on the whole dollar cost averaging versus lump sum. This is from Tony. Rob, I have $65,000 in cash that I need to put into my index 500 fund to balance my portfolio. Should I just dump it all in, try to wait for a down day in the market, or dollar cost averaging? Really what you're asking me, I think, is which option will have the best outcome, and there's just no way to know. What I did in 2018 was I just put it all in. Paul Merriman says, look, if losing a lot of money because you put it all in and the market drops, is going to create such a psychological sort of scar for you than just dollar cost average over 6 or 12 months. And I can't argue with that way of thinking. All right. Well, now you guys have given me work to do on that DFA stuff, which is fun. All right, did you guys ever answer this chess puzzle? I don't see any moves, because then we're going to bring this show to an end. Wait, here we go. No? I don't think anyone, did you guys make moves on this? I mean, I was really counting on you guys. Huh, well, let's look at it. Okay. Can I even put my picture on here somewhere? Is it messy? Oh, there we go, look, yay. All right. And it doesn't hide the chessboard, it's perfect. But it has me looking the wrong way. What if I go this way? It probably hides the chessboard. Whoops. Try this again. Go here and there. Huh, get rid of that. Here. Oh, here we go. That hides the chessboard. Anyway, so Salty tells me rook f1 doesn't work. So when I look at this position, my eyes are just immediately drawn to queen e3 check, because it's a check. It's a forcing move, right? Queen to here. And white doesn't have a lot of options, right? The only thing, he has to move the king, and he's got 3 choices, right? So, well, actually only 2 choices, h1 or g7, g2. The question is, what's going to be my follow-up, right? If g2, I can play the rook here, and that's check, or the queen there. My question is how I can get this bishop involved, because his white squares are very weak, meaning pawns are not covering those squares because they're on the dark squares. He doesn't have a white squared bishop, he's got a dark squared bishop. And the other thing about queen here is that it prevents him from moving this pawn. So I start to think, well, what if I go here, check, he moves to one of these 2 squares, and I move my bishop here with the threat of moving it here, check. Of course, moving my bishop here gives him a move, right? That's not forcing him, it's not a check, it's not a capture, it's not forcing white to do anything. But if I had a second move and I went here, it would be checkmate, or he'd have to lose the queen, take the bishop. If he moved his king here, if he moved his king here, he could come here. But then I can bring my queen here, check. Huh. What moves have you given me? I know I've been a half hour. If I missed any questions, I'm looking back at the chat. I don't think I missed any questions, but if I did, ask them again. I'm down to the bottom of the chat right now. The other thing I could do, if his king ends up on h3, there might be one approach where I bring my rook to f6 with the threat of rook here pinning his queen. All right, we've looked at this long enough. I'm going to go here. We got that one right. So now I'm going to go here. I got that one right. Well, that doesn't do anything for him. Oh! See, I was too sure of myself. Maybe the problem is he can interpose the queen if I take. But why would that be a problem? I'm guessing this is the answer. Yeah. So I don't know why I had to take the bishop first. Obviously, the bishop could have taken my queen, but I was going to take his queen with check. Here, 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 here. If I did this, oh, because he can take the bishop first, and if I take back, yeah. I should have seen that. Anyway, so we got half of it. My rating probably didn't take a terrible drop. All right, enough chess. Let's see what we got. Anything last minute before we bring this show to a close? My chat window is definitely longer than my monitor. It's not even salty. You don't see the big payoff in terms of the, what do you mean? Look, we've won the queen. We've got a queen and a rook against two rooks. That's the payoff. Why do you think Warren Buffett wants his assets invested with Vanguard when he passes as opposed to leaving everything with Berkshire? Kind of odd, no? Well, I think he's specifically talking about money he's going to leave for his wife. He's actually giving all of his Berkshire stock to charities. But you know, I suppose maybe he wants to avoid his wife having significant risk being invested in one company. Yes, it's Berkshire, but this will be after he's gone. I think he has absolute confidence in the management team that he's set up, but maybe, you know, there's also trustees involved, and it just may be easier to just put it in an index fund. Those would be all my guesses. All right, I think I've caught up with everything. All right, gang. Well, as always, I appreciate everyone. Oh wait, we got one kind of last minute. It was like going once, going twice. Christopher says, Roth 401k, my company has started to offer it, and I moved all my future contributions. Any reason against it besides saving tax now? Seems like no-brainer to go with anything Roth. Well, in theory, it depends on your current tax bracket and what you think taxes will do in the future. If I were in the highest tax bracket living in New York or California, I'd probably stick to traditional. But assuming that's not the case, you're in the middle, somewhere in the middle, you know, both in terms of federal taxes, state taxes. I like Roth a lot. So, but it really depends on your tax situation, whether a Roth makes the most sense. So, all right, gang, appreciate it. It's been a lot of fun as always. Thank you for tolerating my chess puzzles. And I'm going to probably do more of them this afternoon after I get done researching DFA ETFs now. Thank you. But man, have a great week. We'll be back next Thursday. That's the plan, 11 a.m. Looking forward to it. Until then, remember, the best thing money can buy.